You're listening to the Applied Blockchain Podcast, hosted by Ben-Ari, founder and CEO of Applied Blockchain. Join him as he sits down with global experts to uncover how blockchain is driving real-world impact. Today's guest is Geoff Kendrick, Global Head of Digital Assets Research at Standard Chartered, and one of the leading voices shaping institutional thinking on stablecoins and digital money.
Welcome to the Applied Blockchain Podcast.
Thanks, Addy. It's lovely to be here.
It was great meeting you at the European Blockchain Convention at the side event where you were on a panel. Geoff, for our listeners, could you give us a bit of background of how you got into the space and what you're doing at the moment?
Absolutely. Thanks, Addy. So I run digital asset research for Standard Chartered. My background is as an economist. I started as an economist back in Australia, those who can recognize my accent. I moved across from in Treasury in Australia to then working as an economist in banking, and then took that career to London about 20 years ago now. So I was working most of that time as a macro strategist focused on FX and rates markets, first in major markets, G10, and then I moved across to emerging markets, what must be, I guess, about 15 years or so ago now. And then in the previous cycle high for digital asset prices around 2020, 2021, a number of banks started to cover digital assets from the research perspective. And my boss asked me if I would like to do the same. And it's probably fair to say I came at the asset class somewhat cynically. I knew something about it, but not that much. But once I went through the looking glass, for want of a better phrase.
And down the rabbit hole.
Well, exactly. All of those types of analogies that we like to use. Once I got to the other side, it's fair to say I really just grabbed this opportunity with two hands. So I was double hatting for a couple of years, both looking at emerging markets research still, pretending that I was still very focused on that when my boss asked questions, but really I was learning about this asset class with the plan to hopefully get to where we've got to today, which is I've been doing this now full time, got rid of the other emerging market hat a couple of years ago. And as far as I'm aware, I'm the only person in any bank globally doing this full time today, which is wonderful. So I try and take, given that background, quite a detailed approach. So I try to do lots of data digging. My basic approach, given my client base, is to try and stand in the middle of information between crypto natives like yourself on the one hand, and then TradFi on the other hand, who, quite frankly, until the last couple of years, knew almost nothing about digital assets, right? So most had heard of Bitcoin, but then with the ETFs in the US last year, TradFi has started to realize they need to think more seriously about this asset class from an investment perspective. And then with things happening like stablecoins and DeFi in 2025, the disruptive capabilities are also starting to come through for TradFi. So again, I try and stand in the middle, deep dive a lot of the complex things, then make it relatively easy for readers and listeners to follow what I say after that, and try and reflect this back to other asset classes as well.
Yeah. Okay, very good. So let's go back to the beginning there. So you entered this when your boss asked you to take a look at it, and you mentioned sort of quite a cynical entry point. Can you take us through that? So what were your views when you first were asked to look at it? And maybe how has that evolved? Yeah.
Yeah, I mean, because my background is as an economist, and you still hear economists make these types of assumptions today, i.e. what's standing behind digital assets, right? So in the same way people say, what's backing up fiat currency, those types of analogies was probably where I was originally, not fully appreciating either the technological breakthrough potential, which I think is actually really what blockchain's doing, or the desire within that technological breakthrough for people to be able to invest some of their money in something that doesn't have a central authority. So it's probably fair to say I didn't have a full understanding or appreciation of those basic points. And again, you see economists, particularly in the public sector, make some of those mistakes that I was making 4 or 5 years ago as well. So, but once you understand more fully what the technology can unleash, both in terms of if it's to take Bitcoin for one, I see it now as a way for individuals or institutions to store wealth in something that has no central authority, right? So if you think about when there are issues in TradFi, so March 2023, a couple of banks, regional banks in the US went bust over a weekend, Silicon Valley Bank being the one that people most focus on.
Mm-hmm.
With that, in probability space, then it makes sense for people to want to have some money in a system that doesn't have a central authority if central authorities are at risk of going bust, either in that SVB example, or quite frankly, where the Trump administration has gone this year around Fed independence and other things which have added risk to treasury markets, for example. Again, it probably makes some sense to have some wealth in an asset class that requires no central authority. So I think that's the relatively easy in for people to understand is Bitcoin and its use case like that, given issues in TradFi, and obviously given that Bitcoin came out of the financial crisis in 2008-9. So I think once people get there, they can then also start to say, well, what else does the technology unleash? And then you start thinking about others, right? Like Ethereum, which is the largest blockchain that does things. Yeah, so I like to think of Ethereum as being quite similar to the iOS in my iPhone, right? So on my desk here, I've got 2 iPhones, like we all do these days. And within there's iOS. Look, I'm not a technology guy, I'm an economist. So quite frankly, I don't really know or care what iOS does, but I know that you can build applications on top of it. And
you couldn't do that on the old Nokia phones, right?
Well,
and that's kind of your Bitcoin, right?
Well, exactly. Yeah, that's also a good analogy. Not the old Nokia phones, which these days are quite trendy. I guess Bitcoin's quite trendy as well, right? So, so Ethereum is your iOS. You can build stuff on that, which again I think people can appreciate, right? So we all use apps on our phone in the same way you have app protocols or applications or whatever you want to call them that are built on top of Ethereum, be them for trading or lending or other purposes, or more broadly in 2025, stablecoins. So you're starting to lead into things that are built on Ethereum with the same technology behind it as you have in Bitcoin, but you can do some stuff now, which is fantastic. So I think, again, that has been difficult for people to fully appreciate the technological change that is starting to build now on the back of that. And so I try and explain quite a bit of that and where the use cases are going as well.
Yeah. There's two probably quite hard things to reconcile there, right? Because I guess you mentioned the demand for Bitcoin and maybe cryptocurrency in general being people wanting to store their value, maybe hedge in a way, right? Store their value in a place where there isn't a central authority behind it, I guess. And at the same time, we're looking at the technical efficiencies that you alluded to, maybe in both Bitcoin, but maybe to a larger extent on Ethereum, where you can have these different applications. And now you've got TradFi, as you described it, looking at this and eyeing those technological innovations and efficiencies. How do you see those things reconciling, if at all?
Yeah, it's a good point. So it is quite ironic that it's taken, well, firstly, I guess at the start of 2024, the ETF launch in the US, and now banks and TradFi more broadly getting involved to in some way legitimize the asset class, right? So considering where it came from, which was, a more liberal outside of mainstream type society, the interesting part for me is that we're now starting to get exactly the outcomes that people originally thought we might get from Bitcoin, but we're getting it in a more central way, which I'll explain in a sec. So the original idea of Bitcoin was, as well as storing wealth, with no central authority was to enable peer-to-peer or business-to-business transactions without a bank standing in the middle, right? That was one of the big things that we all heard about 15 years ago, and it's taken a long time to become reality. Now, it's taken a long time because Bitcoin, the transaction costs are too high, and actually Bitcoin's a bit too slow in order to run that. But stablecoins, which are primarily built on the Ethereum blockchain, are pegged to the US dollar, 98% are pegged to the US dollar. And essentially, it's a way to get to that peer-to-peer or business-to-business transaction in a global sense. Yeah, so today, stablecoins do for money essentially what the internet has done for information for the past 2 or 3 decades, right? So if you think about, in the old days, 30 years ago, you'd have a stack of books called an encyclopedia on a shelf behind you in an office like this one. To think about that today seems ridiculous, given the internet has been around for information for such a long time. And in each of the 2 phones I mentioned before, I could find out everything that human society has ever done.
And that's before you get to AI laid on top of that.
Yeah, exactly. Like even in its most basic sense, and that's been around for such a long time. But for money, that hasn't been the case. In fact, the payments rails that financial institutions use today were built in the 80s and 90s globally. They're very outdated. And because of that, when you send money globally, for example, it could take weeks for money to arrive, right? And stablecoins are solving that now, and they're instantaneous or near instantaneous, near zero cost, 24/7, and can operate in any country globally. So it's essentially created an internet version of money for the first time. It's amazing it's taken this long, to be honest with you. But in 2025, they've really started to kick on. And where you went before is, you're right, these things are a bit more centralized. So the US government has said, if you would like to be US regulated as a stablecoin issuer, basically you need to back everything that you print with a treasury bill. So if you issue $1 million worth of stablecoins, then you need to hold $1 million worth of T-bills. And that's where the US administration obviously likes this, because it's a new buyer for treasury debt, right? So you have gone a bit centralized in the solution space because of that link back to government under stablecoins, and also with banks and others starting to get involved. But the technology it's built on, the blockchain technology, remains decentralized. And so that's the key part. Yeah. So Ethereum has been around for over 10 years. It's never had a down day. It's decentralized with thousands or hundreds of thousands of computers backing up the system. And so you have the core technology piece being decentralized, even though some of the regulation is becoming centralized, i.e. you need T-bills behind stablecoins, but you're solving this peer-to-peer style transaction point, and you're now enabling the 1.7 billion people in the world that remain unbanked to get access to the global financial system for the first time, which, again, is sort of what we were hoping Bitcoin would do 15 years ago. So that financial inclusion point is coming through now, which is life-changing for those in emerging markets, or people that haven't been banked and really have not had access to what in the West we think is normal.
Yeah. Amazing. And Geoff, in the conversation we had I think it was in Barcelona, you threw out there some predictions, and I've seen you put some, you've got some numbers that you put out there occasionally. Can you share some of that with us and maybe talk through what's behind that?
Absolutely. So for stablecoins today, the total market cap is almost $300 billion. We're getting close to that number. The original use case for stablecoins was as an on-off ramp for trading crypto assets. And at the start of 2020, that accounted for about 50% of all stablecoins. Today, that number is about 23%. So of the 300 billion today, 23% only are used for on-off ramps for trading digital assets themselves. And the rest now, actually, the vast majority today is used for savings in emerging markets and some for transactions. And I think that will continue to grow exponentially and therefore for total stablecoins to get to about $2 trillion by the end of 2028. And the way we get there is that if today about two-thirds, so about $200 billion of that $300 billion is for emerging market savings use, today almost all of that is in large wallets. So think about super wealthy individuals in either politically or economically challenged emerging market countries globally, right? Of which there's obviously quite a number. So these are wealthy people that had the wherewithal to say, you know what, I wouldn't mind getting some of my wealth out of my local currency, out of my local country for political or economic reasons, and storing it in what is essentially a dollar-based bank account. Is what stablecoins are doing today. So in previous cycles, this is a similar style of flow that would have come out of Asia and bought West End London property. So, I mean, I lived in Hong Kong 15 years ago. You'd look in the Sunday newspaper, there'd be ads for various places in London that you could buy property.
I'm sitting in Canary Wharf, so we're surrounded by those tower blocks.
Well, exactly. So, so that money now is going in stable coins, is the point. It's about two-thirds. My theory here is that so far it's only been the super wealthy that have got involved. Over time, their slightly less wealthy friends and sisters and brothers and cousins and, you know, golf partners, etc., will also get involved. So that will be a large part of the growth. And then in addition to that, you also get the billion or so less wealthy individuals in these same countries. So think of Brazilian taxi driver types that, again, would like access to store wealth in a dollar-based bank account. So over time, I think you'll get a lot of money in the super wealthy end and also a lot of money in the less wealthy because there's a lot more of them. And so over time, I think that will see about $1 trillion leave emerging market banks in the next 3 years to get you to more than half of that $2 trillion estimate that I have for 2028. It could create some pain in some emerging markets. So where there's high inflation locally, where rule of law or political stability may not be as great as we expect in developed markets, where there's good access to the internet, and so there's both demand and ease of ability to get money into stable coins, I would say you'll see significant outflows. And there are a number of countries that I would put in that sort of risky end, if you like, where you'll probably see some money leave local banks, which makes quite a lot of sense to me. Like if you're in some of those countries and you had access to the internet, all you need is VPN. And it's very, very difficult for central banks and governments locally to stop that flow. All they can really do is try and have better policy, right? Which would be a way to decrease demand for stables. But without that, I think you'll see stablecoin adoption continue to expand in emerging markets, in particular for that savings use. So for me, that's going to be more than half of my $2 trillion. And then the other part is developed market transactional. So the amount of conversations I've had with Midwest US corporate treasury types in the past few months, so both in the lead up to the Genius Act, which passed in July, and beyond that, which, you know, questions have come in like, what are stable coins? How can I use them? How much money can it save me, etc. And you think about an organization that would have operations in lots of countries globally. So distributors or commodity producers or manufacturing hubs, right? The companies are in 20 plus countries globally, where a lot of those end in stan or equivalent, right? So slightly less friendly places to get money in and out of. In the past, said corporate would have to have extra cash held in each of those locations because, you know, if you had a bank account with Chase in New York, it could take a week and a half to get it to Uzbekistan to play out that example. So you need to have cash stockpiles in each location. Whereas with stablecoins, you don't. Because you know the money is going to arrive, and it's going to arrive instantaneously, anywhere, 24/7, any day, right? So because of that, corporates are interested, and when they start to go from interested to taking action, which the Genius Act allows them to go to their boss and say, look, this is a great solution, it can save us money, and the US government says it's safe, then you're going to get a massive take up. And that'll start to replace traditional banking rails in payments. Also in FX markets, I think you'll see 10 to 20% of the FX market globally go on chain in the next few years as well. So
that's it, because presumably those payments, when they land in those countries, they then need to be, they need to be converted to local currency. And again, probably for the similar reasons to what you've described, there'll be use cases where there'll be a need for that local currency to be in stablecoin form as well, or demand for that.
Absolutely, yeah. So today there's not much of that. It's almost all in dollars, partly because of that savings point, which will all be in dollars. But I think you're right. Over time, you'll get stablecoins in local currency terms that are liquid enough. They don't have to be massive because these will be high velocity stablecoins for FX purposes. But you'll end up with enough liquidity in most of the majors in the next couple of years, such that FX markets can go on chain. And I mean, why not? Today, FX markets have gone from what was T+2 to T+1, which was good last year. But this is T0. And because of that, you have no costs around settlement, etc. And it's instantaneous and you know when it's going to arrive. So I think we go there.
Do you mean by that, sorry, when you say FX markets going on chain, do you mean in I guess in the technology sense as well? So like decentralized exchanges, swaps, being smart contract based?
So I think you'll have a combination. The spot piece via stablecoin pairs is easy to imagine. And that's easy to imagine in the next 12 months or so, really. All you need is liquidity and non-dollar stables, and then you'll just do those transactions on chain, right? So I think that part's easy. The options and swaps and other, I think, could come too. It's probably, let's call it phase 2 or 3 down the track. So for me, I'm mostly focused on the spot market piece, 10 to 20% of that going into a stablecoin variety in the next few years. I think is very, very easy to imagine. A lot of banks are looking at these types of solutions now. So I think we go there. It has obviously cost savings and time saving solution for users. And that's then enough, if you stack those up, to get you close to that $2 trillion in total stablecoins outstanding by the end of 2028.
Okay. And do you see it going beyond that? So I guess a couple of things that I would borrow from the crypto world. One would be on-chain lending markets. Maybe some tokens used as collateral. Those could be stable coins, other types of assets, and then something similar to what we've seen, on-chain in the crypto world. And the second would be, things like money market funds, I guess, and other types of funds that could come on chain and be used alongside stable coins, or I don't know. What's your view on all of that?
Absolutely. So I actually put out a research note today, which you wouldn't have seen yet, Addy, on this part. So the non-stablecoin tokenized real world asset market size today is about 35 billion. Like, it's tiny by comparison to stablecoins. I think that will also make it to $2 trillion by the end of 2028.
Wow, that's quick.
And the reason and the way we get there is as follows. So stablecoins, in my mind, in 2025, have done 3 things that are required for other real-world tokenized assets to go on chain at scale. The first is, in developed markets, people know about DeFi now, which is great. So that definitely wasn't the case before everyone started hearing about stablecoins this year. So I think in emerging markets, people knew about stables because of the savings, but now in developed markets as well, a lot of people are saying, okay, well, what else is behind this? So that's step 1. Step 2 is that stablecoins have created the necessary liquidity on chain for other real world assets to be able to trade in the way they need to, right? So weekends, etc., right? Without significant stablecoin liquidity, it would be impossible to have 24/7 DeFi outcomes for tokenized equities and others, which are really just getting going so far. And the third is stablecoin lending on chain, so on Aave and its competitors, for example, have started to explode this year. because of extra stablecoins being in existence and also because of the knowledge point. So the average amount of stablecoin new borrowing a day now is between about $1.5 to $2 billion, which has been a massive increase this year. So with those three things, knowledge/awareness, liquidity, and lending booming now on chain because of stablecoins, I think that sets up the next stage for tokenized real world assets. So far, there's only really been two areas in tokenized real world assets that have been somewhat successful. Private credit. So there's a home equity loan withdrawal story in the US that has more than $10 billion in it today. And the other has been front-end T-bills, basically. So essentially money market funds that you mentioned before. And the latter has come about mostly to get yield on chain. But if you think about the stablecoin story from before, and you imagine a corporate. So if you're a corporate today, and I'm going to make up the numbers, if they've got like $1 million today off-chain, they'll probably keep about 90% of that in an off-chain money market fund, right? And about 10% in cash, so they can use the cash, right? Tomorrow, when they go on chain with that money, they'll probably just replace. So they take the $1 million and go on chain, and they park 90% in money market funds on chain and have 10% in stable coins. Now, the reason they'll do that is because they'll want to have access to the better performance that stablecoins provide. And so then when they have stablecoin money on chain, they'll probably bring most or all of the money market fund money on chain as well, right? Because, what's the difference between having with BlackRock off chain or BlackRock on chain? I mean, it's the same end product, right?
Yeah.
And once you use the on-chain rails, you'll see they're easier and better to use than the off-chain ones. So because of that, if we end up with just, let's say, 10% of payments and FX markets on-chain in 2 or 3 years from now, which I think is quite likely, then you probably need to have 10% of the money market fund market on-chain too. And in the US, that market's $7.5 trillion. So if you have 10% of that, that's $750 billion in tokenized money market funds, in my research from today, by the end of 2028, I think is quite achievable. And then if you get that, and you also start to get some regulatory clarity, pardon the pun, given the next act is the Clarity Act that we're hoping from the US, but you'll also get SEC guidelines, etc. Then you also start to open up tokenized assets in large scale too. And so there's been quite a big push in tokenized equities recently. But if we get the Clarity Act and the SEC guidelines, and that falls through to, at some stage in 2026, the average US investor is allowed to buy a tokenized Apple stock and put it on Aave to earn DeFi yield, or trade it on Uniswap, both of which I think are relatively likely next year, then that tokenized equity bucket also explodes. And you only need very small percentages. The total listed equity market in the US is $60 trillion, 60. So you only need a really small number of that to go in tokenized equities. I think tokenized equities by the end of 2028 could be another $750 billion. So matching up to the tokenized money market fund point that I made before. And then you're already at $1.5 trillion. And then I think you'll also get other things like funds go on chain as well. So you'll end up with one of the large fund managers putting something on chain that's in the tens of billions of dollars next year, I think is highly likely. And then they'll all follow, like you get one leader and then the others will follow. So that could add another $200 or $300 billion. And then you get gradual build out in illiquid commodities and other space. And perhaps you get to another $2 trillion in total for tokenized non-stablecoin real world assets by the end of 2028. So this space for me is actually now the true leverage, which stablecoin has created the knowledge, the liquidity, the lending on chain. So stablecoins have started to basically build out.
It's also created users, because I think one of the things that happened in the crypto cycle of 2018, 19, when we had all the ICOs and then the NFTs and so on, is that people got their hands dirty with this. It brought a lot of people, a lot of young people actually, to just use this stuff, and that's part of the education piece, I think. And stablecoins are bringing users in to start using this stuff in the first place.
Yeah, I 100% agree with that, Addy. So I often say to people that are totally new to the space, like you use the analogy that you don't learn to ride a bike by looking at the bike, right? And so,
Or reading
um,
about it, or even listening to
well,
podcasts about it. Well, this is great.
well, yeah, listening podcasts, exactly. So, and so I advise like corporate treasurers to just do a small transaction, like $100. Just do $100 on chain. I mean, who cares if you mess it up, sort of thing, right? But once you use it, you're right. Once you do it once or twice, that's just the technological cycle
Yeah.
goes exponential. And so I think you're right. Like users of stables will then do other things.
Yeah.
Even if they're using stables for corporate, they might, go in their personal investment space into tokenized Apple stock with Ondo, and then take that, plug it into Aave. Like, so
Yeah.
it kind of feeds on itself. I think you're right.
I've got a couple of points and questions. So I guess even looking at this as an SME, we're now exploring getting some treasury into stablecoins and then access to a money market fund. And then as a techie, the first thing that comes to my mind is, can we automate going in and out of the money market fund? Because we've got an invoicing system on the one side, and then we just want to maximize the yield of any funds that we have sitting around until the last minute, right? So we
100%.
yeah, so we could automate that. And you can imagine, because this is digital money now, right? You can imagine what that would do to a corporate, right? Just the efficiency gains, right?
I agree. I think once we get AI agents at scale, so
Yeah,
probably next, probably 2026, right? From the sounds.
yeah,
You're right. Both corporates and also individuals can become unbelievably capital efficient with their money, right? So
Mhm.
I live in the UK, I get paid monthly. If I want to put some of that into investments or paying off debt or whatever, mostly I have to be proactive. Like I can set up some direct debits and some of the automated stuff, but like I kind of need to be awake and doing stuff, like to actually be proactive about it. But
Mhm.
with AI agents, the second my payslip hits my bank account, I can plug that straight into BlackRock's tokenized money market fund on chain and start earning intraday yield,
Yeah,
right? So like zero risk, you can just park it in there for a few days before you pay your mortgage, like at the end of the month or whatever it is. So like there's just basic efficiency stuff, which is once people realize, both individuals and corporates, you're right, this thing then explodes and we start, in a couple of years, we'll look back and say, oh, in exactly the same way we did 10 or 15 years ago when I first walked out onto the street with my phone and was able to order a stranger to come and collect me in a taxi, right? Basically in a car that was just his personal vehicle.
yeah,
And today I think using Uber is normal, right? So in exactly the same way, with this technological solution in a couple of years, the average person will think it's totally normal. Quite frankly, won't even know it's built on blockchain technology.
yeah. Yeah, I'll just be a no-brainer. Agreed. So, Geoff, just before we go, well, I've got quite let's say a bit more of a challenging question. You talked about the developing world and developing countries and people, in particular individuals using this initially, and you're saying, I think you talked about 80% of the stablecoin demand there. And then when you've talked about regulation, you've quoted obviously the big changes we've had in the last 6, 12 months in the US, right, with the Genius Act and the Clarity Act. When you're putting together your numbers, how do you look at regulation? And what do you think about in terms of regulation and what that does to the numbers?
For me, regulation, if done well. So let's say what we've seen in 2025, I think, out of the US.
Mhm.
So proactive regulation, which is trying to take advantage of the technological benefits. In that case, regulation is an accelerant of a pre-existing trend. So that in my mind, there's been a pre-existing trend since 2008 of banking activities going into non-banks. Regulation like the Genius Act accelerates that trend, which is wonderful. And so that's an easy way to get to bigger numbers. Obviously, in previous administrations in the US where we had regulation via enforcement, that was more of a squashing influence, if you like. So it seems those days are over. And I suspect by the end of 2028, at the end of the Trump administration, the asset class will be so large. I mean, in my mind, $2 trillion of stablecoins, $2 trillion of tokenized real-world assets, let alone the digital assets like Bitcoin and other that people normally think about. And so you're going to be in tens of trillions of dollars for the overall asset class size by then. So it'll be impossible to unwind. And presumably the benefits that we've been talking about during this session will also be quite widely acknowledged. And the average investor and the average voter, therefore, will be bought into the system. So I think we've gone from destructive regulation to constructive regulation, I suppose, to summarize.
Yeah. Okay. And then finally, if I think about some of the regulators and TradFi's response to this has been to create their own products or to explore creating their own products, maybe to compete with stablecoins, right? So we obviously have some governments looking at central bank digital currencies, and we have some banks looking at and issuing tokenized deposits and deposit tokens. What are your thoughts of that in relation to everything else we've talked about?
So I think because the US administration has decided to go for private stablecoins, just because of that simple decision, which we could debate, which is better, but because of the private stablecoin solution US administration has gone for, that means that private stablecoins will almost certainly win over central bank digital assets globally, because liquidity matters a lot, right? So you'll have a few central bank digital assets, but I think they'll be quite niche by comparison to stablecoins. For tokenized deposits, it's feasible that both succeed for a period. The technological difference between the two, in my mind, means stablecoins will end up winning rather than tokenized deposits, because in simple terms, tokenized deposit is kind of like an intranet and stablecoin is kind of like an internet, right? So the silos around tokenized deposits are similar to in normal deposits today. So I suspect stablecoins win, but the tokenized deposit story can succeed in pieces for a period, I think. And there is a possibility here about creating more leverage in crypto trading type activities for hedge funds and other, which I think is very, very powerful. So because stablecoins require 100% T-bill backing in this narrow banking sense, it's not a leverage system or a credit creation system, whereas tokenized deposits can be used to have credit creation behind them. So I suspect both will win for a period, but if I have to pick a winner medium term, for me, it's because of the internet versus intranet side. I suspect it's stablecoins that ultimately prove successful, but this could take a number of years to play out.
Yeah. Okay. So we'll get back here in a number of years and see where we got to. Right?
Exactly.
Geoff, one thing that I ask all our guests before we end the show is to recommend some source of information that they found useful. It could be a book, it could be another podcast, could be anything. And it doesn't have to be related to this topic either.
So the main, if I think of myself when I started learning about digital assets, which was during COVID, so it was sat at home, working from home with my work laptop and my personal laptop to the side, kind of going back to scratch, right? I think the key really is these days on digital assets, so long as someone is intellectually curious, you can like Google or find videos on YouTube or whatever, like on basically every piece of information you need. Some will be official. So I remember watching lectures from US universities on blockchain. Then I would look at blogs, I would look at and listen to podcasts. I would really just kind of deep dive and go with that intellectual curiosity point. And if you believe again on you don't learn to ride a bike by looking at a bike, you kind of deep dive it as much as you can and go down the rabbit holes, look at the websites of Aave and, kind of get into DeFi yourself or get your hands dirty. And actually when you do that, you'll find the average person will find this is quite accessible actually. There's always anchoring biases because in the past there were bad headlines related to crypto. There's confusion because it's a technology solution. But, if a simple economist like myself from Australia can deep dive on their laptop and learn about it over the last few years, I think anyone that's curious can do the same. And so that's what I would encourage people to do. Okay,
amazing. Geoff, on that note, I want to thank you very much for joining us and sharing your thoughts and insights and learnings with us. Thank you very much.
Pleasure. Thanks, Eddie.
Thanks for tuning in. Catch every episode wherever you get your podcasts. Follow Applied Blockchain on socials for the latest insights and explore our layer 2, Silent Data, at silentdata.com.